Bart, criticizing your good work?
I know. I mean, maybe they're calling me a turkey. Who knows?
So tell us, give us more context here.
Well, one of the commissioners, who I actually respect a whole lot, Chris Giancarlo, said that we had botched the policy analysis on our swaps rule. Now, to cut through all the mess for people, you know, swaps are something that were not regulated prior to 2010, prior to Dodd-Frank, and actually helped lead to the economic calamity of 2008. So we were charged by Congress, the regulators, with regulating swaps, and we did that. But we did it based upon no data. I mean, it was tough. And so he's criticizing the policy analysis, but as David and Bill probably remember that old Billy Preston line, nothing from nothing leaves nothing. So we didn't have anything to make the policy basis on. We did the best we can. If the regulators want to revisit the issue, that's certainly appropriate, and I encourage them to do so. But right now, we say that if you have $8 billion worth of swaps trading, $8 billion, that you have to be registered. That moves down beginning in 2018 to $3 billion. But for me, you remember Everett Dirksen, he said, you know, a million here, a million there, it ends up talking real money. Well, I think $3 billion is a lot of trading, and it probably should at least have the folks who do that trading be registered with the agency.
So, Bart, for those of us who may not be as familiar with this marketplace, explain to us what the new proposed regulations would do. You'd have to register if you have this auto trading, and also have to reveal your algorithms, go through exactly how your business worked. Is that what it is?
Well, there's two separate things, actually, David. So there's the one rule is a rule that we passed a couple years ago with the registration, and that is for swaps dealers. It goes from $8 billion. If you have more than $8 billion in annualized trading, you have to register. That goes to $3 billion. That rule is actually already passed, although there's a study now that they're revisiting. But with regard to the meeting that's being held at the Commodity Futures Trading Commission today, it involves algorithmic trading, which, you know, I've talked about for years. And the proposal I expect that they will consider today, and that will come out for public comment if it's approved, will require that proprietary traders, some of which aren't currently registered with the agency, that they're registered, that they conduct testing of their programs prior to being used in the production environment, the markets, and three, that they have kill switches so that if something goes awry, that you can stop it. They also may deal, David, with transparency of these market maker programs, these incentive programs, which both the CFTC and the Securities and Exchange Commission are looking at to decide whether or not those are helpful to markets. And finally, they may deal today at the CFTC in just an hour or so here with self-trading. Some people call it wash trading or roundhouse trading. That has been traditionally illegal, wash trading. But with the advent of technology, that just seems to happen a lot, the self-trading, because there's so many orders being put into the system at once, and so they may further try to delineate that.
Hey, Bart, it's Bill. What, if anything, do these new rules or the existing rules have to do with helping us understand price of these derivatives? They're notoriously difficult to price, difficult to value, and that was a big problem in the crisis. People couldn't value these contracts. Part of putting the idea of, I think, of putting the derivatives on exchanges and having more disclosure, more transparency, was to help price discovery. Where does all that stand after all this dust is settled and with these new proposals under consideration?
Right, Bill. Well, you mean, you know, you've written about this stuff many times, so you know it well. The bottom line is people didn't have a good sense of what their risk was. So when Bear Stearns went under in the spring of 2008, when Lehman went down and sort of was the linchpin that helped lead to the calamity in the fall of 2008, a lot of firms didn't know where their positions were. You could ask the guy in charge of equities what the exposure was to Lehman, or ask the guy in charge of futures, but you didn't have any net. Fortunately, there's technologies that are being developed right now. Matter of fact, some of them are in place, which actually tell you what your exposure is. That's a huge financial technology advantage. But additional reporting and record keeping of these swaps dealers, the proposal that, or the rule that's in place, and the additional transparency of these, the potential rule that the CFTC will act upon today, should not only help with price discovery, but it should help with transparency, and transparency breeds, in my view, to greater consumer confidence, greater investor confidence. Greater investor confidence leads to better liquidity, and ultimately that's good for price discovery, for consumers, for exchanges, and for the economic engine of our democracy.
And do you believe we have all of this, or at least improvements on all of this today versus 2008? Because many people are concerned that we're approaching more asset bubbles, and if we did see a real downturn in the market, what we could face.
Yeah, Stephanie, I mean, this is definitely, this proposal, quite frankly, it's been too long in coming. We've got automated trading, high-frequency traders, yet in this area of technology, we've had low-frequency regulation. This is something I've been talking about since 2010. And so I'm really pleased that the agency's putting forward the proposal. There'll be a comment period. I'm not sure how long, probably 60 or 90 days. And then I hope that the staff and the commissioners get on this and approve a new rule related to automated trading and co-location, where the actual servers are and where the traders are, that they do that sometime at the beginning of the new year.
All right, Bart, thank you so much for joining us this morning. Bart Chilton, he's a former CFTC commissioner, joining us from Pensacola, Florida.